Okay, my clock is showing 10 o'clock, 2 minutes past 10 in Singapore, so I think we're just going to go get started. Hello everyone, and good morning for those of you in Asia. This is Innosight webinar on disruptive innovation in financial services with a focus in Asia. This is Jenny Chung, manager at the Innosight office here in Singapore. With me is my colleague Annabel. Hi everyone. So we recently wrote an article together on the disruptions in financial services, which you can download at www.innosight.com. We're very excited to be here today to walk through some of the concepts and findings in the article.
And we'd like to keep this webinar as interactive as possible, so do send us questions through the webinar GoToDialogue as they come to mind. We'll share about our findings for about 45 minutes, after which we do have some time to discuss questions that you might have. We will also be running a couple of polls during the webinar to get your view on some items.
Yeah. So first of all, a very quick introduction on Innosight. We are an innovation consulting firm co-founded by Clayton Christensen, professor at the Harvard Business School. He also wrote one of the best-selling innovation books out there, The Innovator's Dilemma. A lot of the findings that we're going to share will be based on his theory on disruptive innovation. Innosight is set up to help companies achieve sustainable growth, and we have 80 consultants across US, Europe, and Asia. So this webinar is about financial services, and I thought a good way to illustrate how disruption can happen in this sector is to tell you a story. So let's go back 10 years in China in 2004, and that's just 1 year after the Chinese e-commerce leader Alibaba has launched Taobao. Annabel, have you ever tried to use Taobao?
No, I know they do ship to Singapore now through agents, but I haven't tried it yet myself personally. I know that it's an eBay-like marketplace where people can buy and sell items online.
Mm-hmm. Yeah, and the guy here in the picture is Peng, and he was one of the earliest entrepreneurs to set up an online shop in Taobao. He was only 4th year in university when he started selling t-shirts and accessories on Taobao. Right from the start, Peng used Alipay to collect payments since most of his customers do not have a credit card.
Yes, in fact, we know that only 2 in 1,000 people in China had a credit card at that time, comparing to 1 in 5 today.
Yeah, exactly. Without a credit card, you could imagine trying to shop online in China was very difficult since there wasn't much trust in the system. But the good thing about Alipay is that it's actually an escrow service. So it collects funds from the buyer, but it only releases to the seller once the order has been delivered. So Peng didn't have to worry about not getting paid, and his customer feel comfortable buying from him. And step by step, Peng started using Alipay more than just for e-commerce payments. He started paying his bills, his utility bill, credit card bills on Alipay in 2008. And then a couple of years later, when he needs a loan and he couldn't get one from the bank, he managed to get a loan from Alipay using just his trading history on Taobao. And then, again, a couple of years later, when Alipay launched Yuebao, which is a money market fund that offers higher interest rates than his bank, Peng simply keeps all his money in Alipay instead of trying to transfer the excess cash into his bank account every month.
Yeah, so I think this is a pretty typical story of how the first wave of e-commerce entrepreneurs in China became loyal users of Alipay. A lot of them saw their first business earnings coming from Taobao, and then they grew their business over the years and gradually let Alipay manage a bigger and bigger share of their finances. But one interesting question to ask, though, is that while Alipay was building a bigger business in financial services, going from 3 million to 300 million users in 10 years, what have the Chinese banks been doing, and why haven't they responded more aggressively?
And I think to answer that question, we can look back at the same story, but this time from the bank's perspective. So when Alibaba launched Taobao and Alipay, that was 2003, the entire e-commerce market was only worth $200 million US. So if you assume a 3% transaction fee, the entire e-commerce payment market would have been probably less than $6 million US.
It's probably not a big enough market to get banks' attention.
Yeah, I think so. And when Alipay moved into payment, banks were still very much part of the value chain, right? The Alipay was linked to credit cards and debit cards issued by banks. So banks don't really see Alipay as a competitor at that time because it helped drive online banking adoption. And then when Alipay launched loans in 2010, it was initially done in partnership with the China Construction Bank. The idea is that Alipay will build up the credit assessment system with the Taobao transaction data, and then China Construction Bank will actually issue the loan.
So at that time, it looked like a match made in heaven. But when the agreement expired in 2011, Alipay realized that it didn't need CCB anymore. In fact, the credit data that Alipay was sitting on was a much more valuable asset than cash. And besides, Alipay had themselves accumulated a fair sum of cash. So it was only after 2011, about 8 years after the launch of Alipay, that banks realized what a monster Alipay had become.
Yeah, and it is probably too little too late by the time the Chinese banks decided to fight back. So, for example, China Construction Bank, after being left out of the partnership with Alipay, they subsequently tried to launch their own e-commerce marketplace to compete with Taobao, but that was in 2013. Many Chinese banks are expected to do similar things. What banks have realized is that their role in the online payment ecosystem will keep on shrinking unless they start doing something new and start to capture that customer data and building the customer relationship again.
Yeah, but we know that in 2013, Taobao already had more than 300 million registered users. So it's hard to imagine banks beating Alibaba at their own game.
Yeah, that's right. But of course, though, the success of Alipay, as well as the billion-dollar valuations of some of these fintech startups out there, like Lending Club and TransferWise, have sent shockwaves throughout the industry. And now executives in financial institutions around the world, including those in Asia, they're well aware of the need to act early and to defend against disruption. I particularly like this quote by DBS CEO Piyush Gupta. Within the next decade, there will be banks that make the transition, and there will be banks that will die. So it's a pretty serious statement.
Having said that, what's interesting is that most banks still seem to be taking a wait-and-see attitude.
I think the burning platform is there, but just figuring out which of these new entrants are truly disruptive and then developing a strategy against them is such an enormous task. The complicating factor, right? First of all, Asia is extremely diverse. At one end of the spectrum, there's countries like Australia and Singapore with almost 100% bank account penetration. On the other end, there's Indonesia, Philippines, where most people are still keeping money under their mattress instead of in the bank.
So what we are saying is that what is disruptive in one country might not work in another. For example, even though Alipay was successful in China, it's hard to say if it will work in, say, Singapore.
Yeah, and then there's also so many potential new entrants, and the technology is evolving so quickly. It's difficult enough just to keep track of what's going on. Now there's tech giants, mobile operator, retail chains, all of them are trying to get a piece of the market.
So since identifying disruption is so tough, our main objective for this webinar is to share with you a simple framework for assessing if a new entrant is disruptive or not, so that you'll be able to make the call as new players emerge in the future. This framework that we have is grounded in the research done by Clayton Christensen and Innosight over the years on disruptive innovation across various industries.
Yeah, in the process of explaining the framework, we will mention a few examples. Some of them are disruptive players, some of them not so much. But our goal is not really to run through all the fintech startups in this webinar, because that could take half a day on its own. But we will, at the end, summarize the biggest disruptive threats we've seen facing financial institutions and share some thoughts on how FIs can effectively respond to these threats.
So to start off, we'd like to get the group's opinion on which new player has the greatest potential to disrupt financial services. So we'll take a quick poll right now. And we'll look at some of the few prominent new business models which are present in US and Europe, but many of them are just entering Asia. So we'll take a while the poll comes on screen. Yeah. So we see that there are 4 or 5 options here. First, we have peer-to-peer forex transfer, like TransferWise in the UK, which matches people from 2 different countries who want to send money in the opposite direction. Next, we have peer-to-peer lending, like Lending Club, which cuts out banks as the middleman and allows investors to lend money directly to the borrower. Third, we have NFC mobile wallets like Apple Pay, where consumers can make point-of-sale purchases with their phone. And fourth, we have Bitcoin-based platforms, which allow consumers to send money and make payments internationally with potentially a lower fee. So please vote on the above, the one which you think has the greatest potential to disrupt financial services in Asia.
Okay, I think the votes are in. So the top 2 that's being voted are peer-to-peer lending, and the second, or in equal place, is near-field communications, or NFC mobile wallet. That's interesting, and I think we actually will go through a lot of these examples as we walk through the presentation. But interesting to see just now that the response are pretty divided, and I think this is why having more clarity around what makes a new entrant disruptive would be useful. So when we talk about disruptive innovation here at Innosight, what we're describing is a situation where the incumbent is improving and then start to overshoot or overlook certain segments in the market. And these low-cost or low-end segments start to become the breeding ground for new entrants. So new entrants will capture that foothold. It's initially small, but eventually they will improve their performance enough to challenge the incumbents and capture some of their market too.
Yeah, as we probably remember from the Alipay example, it didn't happen overnight. Alipay started small by facilitating e-commerce payments on its own Taobao platform. Choosing this rather small market as a foothold allowed Alipay to quickly drive user adoption.
Yeah, and when any new player tries to launch a solution initially, there could be a lot of imperfections, so the mainstream users may not find it so attractive anyway. For example, in the early days, Alipay doesn't have that much credibility, so it's hard to imagine people will use it on day one to save money. But of course, over the course of 10 years, as Alipay build up its operations, it become more reputable, it has better security measures, people then feel comfortable to let Alipay manage a bigger and bigger chunk of their finances.
Yeah, and as we see on the chart, over the same time period, banks' performance was also improving, but at a slower pace than Alipay. So at some point, probably just before the launch of Yuebao, Alipay's performance matched, if not surpassed, that of banks. So to summarize, the success of Alipay, or more generally, other disruptive players, depends on achieving 2 things. First, enter the market by capturing the right foothold, and second, capture adjacencies through performance improvements.
Yeah, so how do we know if a new entrant is choosing the right foothold, that is, one that maximizes disruptive potential? So there are 3 patterns that we can look at. First thing we know is that typically disruptive players will enter the market that target a strong pain point. So adopting any kind of new solutions require effort, it requires changing habits. So unless people are trying to solve a very difficult, important problem, they're likely to just stick with the status quo. So for example, in the Alipay example we talked about, consumer in China might not have been as receptive if they didn't really want to shop on Taobao. And for P2P lending, which initially targets small businesses and individuals who really need funds but do not have good credit history, you can imagine the frustration and the pain is very high as well.
Yeah, but as we see in the case of NFC mobile wallets, which initially targets retail point of sale transactions, consumers and merchants already have access to good enough alternatives like cash, credit cards, debit cards, and the pain point is not as evident here.
That's right. Additionally, the new entrant solution should be clearly superior to existing alternatives. So NFC mobile wallet, they're definitely more convenient. I don't think there's any argument in that. It's faster in transacting. People don't need to carry so many coins in your pocket. But I think it's arguable, especially for consumers with credit cards already, and they can use cash too. So it's hard to say whether these advantages are enough to motivate people to change behavior. On the other hand, if you look at Alipay, you look at P2P lending, because they're targeting a problem that no good solution exists in the first place. So it is much easier to become the first choice.
Yes, and finally, new players that target a segment that is not profitable to the incumbents have the greatest chance of success. Not getting on the bad side of banks help make sure that the new players won't be forced into an expensive marketing or legal fight with more deep-pocketed incumbents.
Yeah. In the case of NFC wallet, there's actually not backlash. There's no backlash from the financial institutions, but we have seen some retail chains like CVS and Walmart reacting a bit negatively in the U.S. when Apple Pay was being launched. So overall, I think even though it sounded like we've been bashing NFC wallet a lot, but what we want to say is not that if the technology or new business model doesn't fit these three patterns, it means that it will not succeed. What we're saying is that we can expect that more money and more time may be needed to generate awareness, to drive adoption, and to get buy-in from incumbents and from the partners.
Yeah. So based on these three patterns that we just talked about, we have evaluated a long list of business models and highlighted in blue on this page the ones that match all three patterns. So this is not an exhaustive list, and we don't intend to walk through all the examples here.
Yeah, and one thing to note is that some of these business models are more focused on emerging markets, some of them more focused on developed markets, and you can see that on the end of the emerging markets, there are more examples that are disruptive or at least aligned with three patterns we have identified. And I think that shouldn't be surprising because in emerging markets, the banking system is still underdeveloped, so simply more people have unmet needs. And also, a lot of the populations are difficult to serve or too risky to serve, so that may not be attractive to the incumbent. So finding a foothold in the emerging market overall should be easier than finding one in developed market where most of the banking needs have already been met.
Yeah. So we see that capturing a disruptive foothold is a crucial step, but this does not necessarily translate to disrupting financial institutions. So there's one big challenge that startups will face as they attempt to scale. That is, how can they get users to trust them enough to use the service for higher value, more mission-critical transactions and to put a greater share of assets with them. For example, an average consumer like you and I may find it quite acceptable to put a small amount of our cash savings with a P2P lender. But without deposit protection schemes like what banks offer, it's hard to see how we would put our entire life savings with P2P lenders.
Yeah, you can imagine, right? Like if new entrants were to make themselves more trustworthy in the eyes of consumers, they would have to invest. They would have to put money in new technology, in new compliance policies and procedures. All of that costs money. So in the end, whether these costs may defeat the cost advantage of them against banks, it's possible. Thing.
Yeah, so even though moving into mainstream is challenging, it's possible when the right conditions are met, as we can see in the case of Alipay as well. So successful disruptors typically have business model advantages that are sustainable beyond just lower compliance costs. For instance, Alipay has a clear edge against banks because it has access to a large database of Taobao customer data and transaction history, which it can use to assess creditworthiness and make financial product recommendations. And this allows them to expand into adjacencies like loans and money market funds.
Yeah, and then another important factor is the ability of these new entrants to close performance gaps and make their service more secure and more reliable so that they can get trust from adjacent customer groups, the mainstream customers who are usually more risk adverse than the early adopters. And those new entrants where the quality of service depends on an underlying technology that itself is quickly developing would have a good chance of closing performance gaps. So when you think about mobile money service, and that depends on technology like cloud computing, mobile phone data speed, data security, and all these technologies are developing very quickly. So you could imagine mobile money service will become more reliable and more secure over time, and be able to target more mission-critical transactions and manage bigger part of the finances for consumers. In some cases, though, the unique advantages that make the new player successful at the foothold may not be transferable to bigger adjacent markets, or the performance gap at this adjacency could be so huge that it may take years to close. So let's look at a couple of high-profile fintech examples that may face some challenges going into mainstream in Asia.
So the first example we want to call out is the Bitcoin money transfer. Of course, there are many types of Bitcoin startups out there, but using Bitcoin to facilitate cross-border foreign currency transactions is probably one of the most compelling use cases. Recently, we have also seen a lot of new Bitcoin remittance startups targeting overseas domestic workers like Filipinos working in Hong Kong and Singapore.
Yeah, and based on what I read, there are definitely early adopters who are attracted by the low transaction fees. We don't know the exact number in terms of penetration, but there are early adopters for sure. However, most of the customers still seem to be sticking to their default options, which is the money transfer operators like the bank, the Western Union or the banks, because many of them are worried about security and fraud. And if you keep a Bitcoin wallet and if that gets hacked into, there isn't really any customer hotline to call.
Yeah, so the big question is whether Bitcoin remittance will be able to scale and attract the masses beyond the early adopters. And this will require the ability to sustain cost advantages while improving security measures and regulatory compliance. So this is going to be a tad challenging given that the bulk of the cost of running a remittance service go to maintaining physical distribution network and marketing across countries, which Bitcoin isn't necessarily more equipped to do as compared to the incumbents.
Yeah, and then the second type of business model that we wanted to talk through is mobile credit card processor like Square, and has been generating a lot of buzz lately too in Asia. So Square is a global player, but there's also a lot of clones in Asia. So for example, in China, one of the bigger players is Tiandai Pay. So this type of service, where you have a device attached to a smartphone or a tablet and can turn that into a cash register or more device for accepting point-of-sale payment, is attractive to informal and small merchants because the upfront cost is low. However, expanding into adjacent segments like the large retail chain is not going to be easy because most of them already have reliable and scalable infrastructure in place for swiping credit cards.
Yeah, and while the upfront cost is low relative to a traditional credit card terminal, this cost advantage doesn't seem to be very sustainable compared to mobile payment services like WeChat Payment in China, which are linked to credit cards and do not even require stores to buy any hardware to use.
Okay, so now we're moving on to the second part of our webinar. We will summarize some of the key disruptive threats we have seen and also talk about how traditional financial institutions can respond. So we have mentioned a couple of examples of fintech startups that may face an uphill battle when they try to scale, but that doesn't mean that FIs can just sit back and relax. We did find 3 big disruptive threats that could have a big impact on the industry.
So first, in early stage emerging markets like the Philippines and Indonesia, mobile money providers like GCash in the Philippines have expanded beyond remittance and set up a mobile-based bank that offers loans and savings to the unbanked population through an agency network. For FIs, this represents a potential missed opportunity as today's unbanked population could become the middle class of the future, and their financial needs will likely be captured by mobile money providers if the current trend continues.
Yeah, and then in late-stage emerging markets, so online payment platform like Alipay in China that we talk a lot about, and PaySpy in Thailand, they are expanding beyond e-commerce payment and offering a range of online and offline payment services. They're also starting to provide other types of financial services like loans and savings, leveraging their access to customer and transaction data. In the future, I think there is a real risk that these online payment providers can take on the more customer-facing role and then leaving banks or other financial institutions to do the back-end infrastructure provision services.
Lastly, in developed markets, we see that P2P lenders may move from small unsecured loans into adjacent markets like large secured loans, such as mortgage and corporate lending as the market matures. They may also start rolling out the P2P model to other financial services like insurance and brokerage. So if that does happen, banks may see debundling and market share loss in key parts of their business due to disintermediation.
Yeah, so how should banks respond, or how should financial institutions respond? As we talked about, at least in the past couple of years, FI executives are acutely aware of the need to defend against disruptors. Globally, the preferred strategy that we have seen by FIs are typically setting up startup accelerator programs to incubate the fintech companies or investing through their venture funds. One report I read say that only 10% of banks choose to go with the route of acquisition of fintech, but nearly half of them have some type of accelerator programs. In the meantime, there is tech company, credit card processor, telcos, all of them are snapping up fintech companies, so it is a space that is intensely competitive.
Yeah, for the most part, FIs have been shying away from integrating fintech into their operations and rather opting to invest only financially or providing coaching. So whilst we see that running accelerators and making venture investments are all great ways to keep abreast of the latest technologies and to hedge against possible future scenarios, but the upside is going to be limited if the startups are kept completely isolated from the core competencies and the assets of the FIs.
Yeah, so it has been challenging for financial institutions to take bigger steps at transforming their business. So now we wanted to run a poll. So this poll is going to just get pulled up right now, but I'll just start reading you some of the options. So why is it difficult for financial institutions to take bigger steps in transforming their business? Is it because of the burden of legacy systems and processes? Is that because there's a lack of leadership alignment on what the future of the industry looks like? Is that because of risk aversion? Or investment in innovation is just difficult to justify? Or is it regulatory constraints? So you can select as many of these as you see fit. Okay, so the polls are in, and we can see that the top two are the burden of legacy system and processes, and also lack of leadership alignment on the future of the industry, which is interesting. And I think in terms of the legacy system and processes, that's interesting because this is what makes banks successful in the first place, but obviously it makes it difficult for them to innovate.
Yeah, so as Clayton Christensen explained it in his best-selling book, The Innovator's Dilemma, what makes large organizations successful also makes them resistant to change. And this is no different in the financial services industry, because the processes and norms that are in place to ensure regulatory compliance and reliable service also make it tough for FIs to integrate any unproven and new solutions into their operations. So I think this explains why most FIs have opted for getting involved through equity investment or incubator programs as opposed to acquisitions or internal development.
Yeah, and most of the FIs are running a profitable business, so any kind of new initiatives that may rock the boat is going to be hard to justify. So a better way to think about how to react to disruption is to implement two efforts in parallel. The first one is about building a new growth business with some linkage to the core, so not completely separated. but then it should have its own management structure. And then the second effort is to reposition the core business by strengthening existing source of advantages while freeing up resources from low priority areas.
Yeah, so one good example of how FIs built a separate new growth business with a good degree of linkage is the Bank of Philippine Islands. So Jen, could you tell us what exactly did BPI do?
Yeah, so BPI partnered with Globe Telecom and with Ayala Group to set up Banco, which is a mobile-based banking service targeting Philippines low-income households. In the Philippines, only about 27% of adults have a bank account, so it's a huge market.
So how did they achieve this?
So unlike traditional banks, Banco distribution network is mostly based on mobile phones, ATMs, and partner outlets. So that helps to keep the operating costs low. They only have 5 branches, but they do have 2,500 partner outlets, including pawn shops, money changers, convenience stores. So customers have plenty of places to do cash-in and cash-out transactions. And I think it's clever that they intentionally do not make bank branches of BPI Bank part of that network, so that helps to keep the cost low as well as avoid cannibalization. However, they do put the ATMs as part of the network, so that increases convenience of that service.
That's an interesting example, but BPI is not the first bank to set up a low-cost bank as a separate organization from the core.
Yeah, that's right. So we've seen this in the UK, for example. HSBC and First Direct, which is the direct bank, is run as separate businesses. And then in Denmark, LAR and SPA has also set up a direct bank alongside its branch network, but it's kept separate for 3 years to avoid cannibalization.
Yeah. So we see that whenever a large organization wants to succeed in low-cost innovations with a slimmer profit margin, the chance of sabotage is real, and keeping the management of the new business separate from the core is a safe bet.
Yeah, and it is important to set up a new growth business, but of course financial institutions should continue to transform the core business in order to stay relevant as customer preferences change. For many years, financial institutions treat online and mobile channels simply really as a channel for marketing and service delivery. But recently, we have seen more innovative examples of how they leverage internet and mobile computing differently.
So for example, in India, the ICICI Bank combines social media and banking by launching the Pockets app, which allows customers to find and book for movie tickets, pay for them, and then split and share the bill with friends in one go.
Yeah, and DBS actually have done something similar as well. I haven't personally used it, but I've heard about it. They've also launched a couple of location-based apps, including the DBS Indulge and DBS Shopper. So that helps the bank's credit card and debit card users to find discount shoppings and dining deals. It's kind of like part Groupon and part TripAdvisor solution.
And if we look at the insurance space, MetLife launched the Infinity app, which is part Instagram and part digital vault. This allows users to save important documents like insurance policies and birth certificates securely in the cloud and share them with family members.
Yeah. In all these examples mentioned, the common theme is that FIs, they are trying to get more involved and take a front seat in the value chain in all these various situations where customers are spending money and managing their finances. So that could mean moving into an adjacent problem like what MetLife has tried to do, going into secure document storage, or trying to offer more personalized, more accessible service to improve customer experience in the case like DBS and ICICI Bank.
So as we have learned in the lesson of Alipay, letting third parties take care of the customer relationship could be a big mistake. While using third-party solutions like payment platforms and analytic tools could cut down on an FI's investment and improve speed to market, losing track of customer data can mean the loss of a long-term source of advantage.
Yeah, so in the end, what we're saying is that financial institutions will need to think about pursuing a combination of core and new growth efforts in order to weather the disruptive threats. So to win over the unbanked population will require fundamentally cheaper and more accessible business models which is unlikely to be achievable by just incrementally improving the core.
And to avoid losing control over customer and transaction data and being relegated to the back end of the value chain, FIs will need to provide new value-added tools that go beyond automating simple transactions. A lot of these tools may not be profit-making on a standalone basis, but the benefits come from sustaining customer loyalty and securing access to customer data.
Yeah, and then in terms of mitigating the risk of disintermediation by P2P models, FIs will want to consider implementing a separate business model for the underserved segments, and that may mean P2P loans for micro businesses, for example. And the management of these organizations should be kept separate, since the processes and the financial expectations are going to be very different comparing to the core. But it's important to have some linkages, like sharing of data or sharing of other capabilities, in order to maximize opportunities across the portfolio.
So at the end of the day, we believe that it's highly unlikely that traditional FIs will be completely eliminated by new entrants, and the same way that e-commerce did not lead to an end of high-street retail, and online advertising did not kill off all TV broadcasters.
Yeah, having said that though, I think the role of financial institutions will look very different in the future, and I think now there isn't that much room for complacency. Making small bets here and there have been great, but I think to make big transformation, the best time will be before the crisis happens. So with that, I would like to thank everyone for spending, this is about 40 minutes of your day with us so far, with me and Annabel. Look like we still have some of you online, and we have some questions that have been coming in. So we'll spend the next 5 to 10 minutes or so to try to answer at least some of them. So Annabel, maybe you can read out some of the questions and we can try to answer, let's see.
Yeah, so one of the questions we have got is that, okay, you say that banks need to be careful to keep their disruptive new businesses separate from core operations. So why is this so important?
Yeah, so I think it's important. It depends on what that disruptive new business is, but in most cases they're disruptive because they're not aligned with the current processes and the financial metrics of the core business. So for example, if you're a bank and if you're going into, say, P2P lending or crowdfunding, you can imagine these businesses may not make money, for example, for the first 3 years. So it's probably very hard for the core business to accept that. Also, there could be reason to worry for the core business because it's a lower cost. There could be cannibalization worries as well, and that may lead to sabotaging from the core business.
Yeah, we have seen in the case of the financial industry and in many other industries as well. So when salespeople have that, for example, salespeople who are selling loans to customers have a new business model that comes up, and this could threaten their own job or their own salary, they will probably fight back. So that's why it's important to keep this disruptive businesses separate from the core.
Mm-hmm. Yeah. So a second question.
So we see that second question, retail banks have extensive branch networks. Are these a strength or a liability as they try to respond to disruption?
Yeah, I think that's a great question. It's definitely an asset, but also can be a liability, and I think we kind of mentioned that in the paper when we wrote the article. So it's an asset in a way that it does give them unique face-to-face interactions that a lot of these online players will not have. But it depends on whether the cost of running this operation may put them at a disadvantage. We have seen, though, a lot of banks trying to reformat their network into different purposes. We have seen branches that use their banks that use their branches mainly for teaching people how to do online banking, or they could focus it more for more complex wealth management services. So those are some of the ways that we have seen where people, banks have used their branch to their advantage.
Yeah. So we see that it's quite a core. It's quite a. The branches are quite an important part of banks doing the core transformation.
Yeah. So I definitely think that the bank should. It's not like overnight get rid of all the branches. There's definitely value there, but rationalizing the number of branches and format of branches is important.
Yeah, so we have a third question. So Alipay is a good example of consumer banking getting disrupted. So do you have an example of how commercial banking will get disrupted?
Yeah, so I think actually consumer banking and commercial banking could be quite tightly tied. So when we think about, for example, P2P lending, it started with individuals. It also started with small businesses, so SMEs. Of course, initially, these may not be the core customer of the commercial bank, but over time, as P2P lending become more reputable, as we talk about more secure, people trust them more, it is possible that they can then start to get customers from bigger, maybe medium-sized businesses, so they will edge further and further into the space of commercial banking. Yeah. So perhaps one last question?
Okay. So we have another question. What are some of the risks that startups face in terms of gaining broader market adoption? For example, do you think security concerns around online transactions will prevent them from being anything but small niche players?
I think that's a very fair question, and we have seen and talked about a lot of the startups may be able to capture a foothold that are mainly early adopters, but to expand to the mainstream will require investing in improving security, and that cost could eliminate the initial cost advantage they have. And also, we know that small regulators, they don't care at this stage, but as the startup grow bigger, regulators may try to implement different policies and constraints, and that, again, compliance costs money. So I think definitely there will be challenges and security concerns. But I think, again, this is probably something that could be achievable, though, over time as security improves. So it may not be something that changes over the next 2-3 years, but it's certainly still a threat that may happen in 5-10 years. Okay, so I think this is the kind of amount of time that we have, but thank you so much for participating over the past 45 minutes or so. We are recording this webinar and we will be posting it on the website. And the questions that we didn't manage to answer, we'll try to answer them as well and post them on our website. We'll be distributing the deck as well to all the webinar participants. So with that, thank you so much for joining us today and have a good day.